can I ask you something? If I told you there was a perfectly legal way for a CEO to take shareholder money, artificially inflate the stock price, cash out millions in stock options, and then get praised by Wall Street analysts for being shareholder friendly, you would probably think I was describing a white-collar crime, right? Well, you would be wrong. What I'm describing is stock buybacks. And what I'm about to show you is going to make you question every buyback announcement you've ever celebrated. In 2024 alone, S&P 500 companies spent over $800 billion on stock buybacks. Surprisingly, that is nearly double what these same companies spent on research and development. Companies are spending twice as much money buying back their own stock as they are investing in innovation or future growth. Stock buybacks weren't always this popular or even allowed. In fact, until 1982, they were essentially illegal. The SEC considered them stock manipulation because, well, that's exactly what they appear to be. Then Reagan-era deregulation happened, and suddenly what was once considered market manipulation became smart capital allocation. What I'm about to share may make you uncomfortable. The average CEO receives about 70% of their total compensation in stock-based pay. Stock options, restricted stock units, performance shares. Their entire wealth is tied to the stock price going up. So when a CEO announces a massive buyback program, they're not being shareholder friendly, they're being selfish. Because buybacks reduce the number of shares outstanding, which then inflates the earnings per share, and then this drives the stock price higher, which makes their options more valuable. It's the perfect scheme. Take company cash, buy back stock, watch your net worth explode, and then get applauded for returning value to shareholders. Except, the only shareholders really winning are the ones selling, and conveniently, executives are always selling. Here's what you probably don't know and don't hear about. When a company buys back stock, it doesn't create any value. It just redistributes it. The company is worth the same, there are just fewer slices of the pie. So, your slice got bigger, right? Nope. Wrong. Because while the company is buying back shares, executives are selling theirs. Between 2015 and 2024, corporate insiders sold over $90 billion worth of stock during buyback programs. It appears that they are literally using company money to create artificial demand for the stock they're dumping. And the timing is too perfect to be coincidence. Studies show that buyback announcements correlate with insider selling within the following 90 days. This isn't a bug, it's a feature. The system is designed this way. And the real gut punch? Companies love to announce buybacks when their stock is already expensive. Not when it's cheap and actually a good deal, but when valuations are stretched and they need to prop up the price. It's the financial equivalent of buying high and paying higher. Who loses here, you ask? Long-term shareholders who watch the company burn cash buying overpriced stock instead of investing in growth. So here's the question I want to ask you. Do you think stock buybacks are just smart capital allocation? Or are they a legalized wealth transfer from shareholders to executives? Drop your take in the comments because I'm genuinely curious how everyone feels about this. And if you know someone who thinks buybacks are always good for shareholders, send them this video. Maybe it'll save them from celebrating the next time a CEO announces they're looting the treasury.